Unemployment heading down during a retail recession. Let's have a look. Hello everyone, Florian Heise here, and welcome to another episode of HeiseSays. I've got my afternoon stein of coffee, and I thought we'd have a look at this article from Jason Murphy, written on news.com.au, where he's discussing the recent unemployment data, and I will just bring that up right now for you all to see. It's trending down. It went down by 0.1%. Now, before we look at alternative methods of measuring this data, let's go through this article and have a look, because frankly, it's a little surprising. This is different to what was forecast, and given the number of retail businesses we have seen in this 3 weeks of January get in trouble, shut down, enter voluntary administration, I'm interested to see what the unemployment data will hold for us next month. So, lower unemployment reveals economy paradox. We should have been celebrating when it was announced that unemployment had dropped. Instead, it's highlighted something worrying. And here he has the graph showing the unemployment data trending down. On Thursday, we got news about unemployment. It has been improving. In response, the stock market immediately fell. He's questioning what the. A lower unemployment rate is a good sign for the economy, and the stock market is supposed to show the health of all companies that operate in the economy, so why would it fall? Now, is that accurate anymore? Is the stock market, is it there to show the signs of health of the economy, or is there an element of speculation in the stock market that is predicting or anticipating what might happen? And the role of the stock market is allowing people to raise funds, and this speculation in there, it increases the liquidity of these shares and assets. So there's a value to it. There is a value to it, regardless of the ups and downs. In the long run, it's useful having that liquidity there. It's much better when it's easier to sell your stocks instantly if you need to, than if you have to wait. Something people may have encountered in the crypto sphere when they're selling an obscure alt on a low frequency exchange. The answer tells us about one of the biggest problems in Australia today. It's a fascinating paradox at the heart of our economy. But let's go back to the start. He's talking about lower unemployment. December's unemployment numbers had been hotly awaited. Would they be good or bad? It was very hard to predict. Before we continue here, let's just jump over to trading economics, and this is the Australian unemployment rate, and you can see here down the bottom, December, the actual unemployment rate from ABS was 5.1. Previous month was 5.2, but the consensus and the trading economics forecast was 5.2. So they expected it to not change. And what I would say, particularly for the market, how it's responding to the information is the difference between the actual data and the consensus and the forecast. Okay, so if the market responded to or anticipated a 5.2% rate, and then and then one could make the argument that maybe the cash rate will have to go lower, so more money might flood into the market. They pumped it up. People invested their money, they're positioning, hoping they'll climb up. But that we got a 5.1%, that's why it's gone down, because the chances of the rate cut, the cash rate going down, has been decreased. So people are pulling out of the market. They're putting their money somewhere else. October showed dismal numbers, but then November was amazing, and either of those could have been a statistical anomaly. December data was needed to settle the debate about whether Australia's economy was really showing signs of life. When it came, the results was clear. This was good stuff. The number of people with jobs shot up 29,000, and unemployment fell by 5.1%. The only downside, and this is very telling, was that the new workers were in part-time positions, while full-time employment barely budged, and that is the problem. Our underemployment rate is not looking very good. A lot of people are underemployed. This result was not the best result imaginable, but it was a lot better than market watchers feared. A strong labour market means less need for the RBA to step in. On Wednesday, the stock market was predicting a 58% chance of a rate cut at the next RBA board meeting. By Thursday, this had slumped to 28%. And that's why the stock market fell sharply at exactly 11:30, the time the unemployment data was released. So stock prices, house prices, and the RBA. So here you go. Here you go. Let me know if anyone managed to successfully short that. Did anyone did anyone play this situation? In theory, the RBA's rate cuts make the economy stronger. Well, no, I wouldn't argue that. The RBA's rate cuts make it easier to access credit, easier to access cash. They don't make the economy stronger. If anything, it's an artificial stimulus, and it removes the ability for the creative destruction to occur in the economy. And I have to jump back here. I haven't been reading the article. We can see here. In theory, the lower interest rates make it easier for companies to borrow money to build new factories and expand options and therefore hire new staff. That theory worked well for many years. Well, I mean, the problem is, consumer confidence is atrocious at the moment and heading down, and business conditions and business confidence are also getting worse. So does this theory stack up? Is the cash rate at such a low level now? Does it work? And he's talking here about investing in factories and businesses expanding. With that, there comes an inherent level of risk. Why would you invest in any productive capacity here in Australia when it's cheaper to import the products the majority of the time, particularly manufactured goods? And most people here in Australia, there's more incentives for them to invest in property and flip houses as a way of making a better financial return. But recently, particularly with the lower cash rate, recently the theory is looking a bit threadbare, because these days the clearest effect of interest rate cuts is on asset prices. When the RBA cut rates, the economy might improve slightly, but we get a big lift in house prices. We saw this in 2019, not long after the RBA slashed rates to record lows. House prices turned from falling to rising, and I'll bring this up here, property prices. There you go. We can see it right here in this chart. The problem is, with house prices going up, any potential wealth effect that could flow through to the economy is offset, I would argue, or substantially offset to a degree, by people having to save more money. And don't forget, guys, every time this cash rate gets cut, people get worried, people get scared, and people react. Let me know in the comments if that's you, if you're worried. If they hold off on a rate cut next month, that might be a good sign. Remember, it's one step away from QE, and we don't want to get into QE. We do not want to get into QE. And then, we can hope and pray that something happens to turn the economy around. And we saw on Thursday, you need only a change in the chance of a rate cut to get an immediate change in stock prices. Because stock prices aren't really a representation of the health of the economy, they are a representation of people's expectations. Just think about that. How many businesses on the stock exchange, unicorn businesses or zombie companies, that if they liquefied everything, they couldn't afford to pay all their debts? How much money is sitting in businesses that have never made a profit, the valuation of their shares? And how many of them can only afford to exist because they can service their debts at such a low cash rate? The lower interest rates are, the more people want to buy stocks. It makes sense. Stocks pay dividends, and for many investors, that is better than accepting interest rates that are practically zero. So the stock market's recent record highs in the US and the Australian Stock Exchange have a lot to do with record low interest rates. It's the same thing with house prices. Investors want to buy houses because leaving money in cash brings such bad returns. They're able to buy houses with borrowed money paying little interest. The net result is that a weaker economy causes lower interest rates, and lower interest rates cause higher asset prices. Does that make you nervous? It makes the RBA governor nervous. Easier monetary policy conditions will push up asset prices. which brings its own set of risks, he said in a speech last year. For now, we seem to have a stronger economy and a slightly lower stock market. That's great, but when we get data on the economy for January, when the effects of the bushfires come through, the economy could look worse and the RBA might come under renewed pressure to cut rates. And if that happens, we could see the same paradox in reverse, stock markets rising as bad data comes in. Well, it's because the cash rate is artificially low. The cost of borrowing money is lower than it should be. They're intervening in the economy. They're artificially manipulating fundamental things in the economy, the borrowing rate, access to credit, which is having these strange effects. Now, another thing to look at, because we're talking about the unemployment from the ABS, which is 5.1%. Let's have a look here at another website. This is from Roy Morgan. We have the Roy Morgan unemployment and underemployment estimates for 2005 to 2019. And what I'm going to do is I'm going to snip this little bit at the top here so we can see what we need. Now guys, what you need to realize, Roy Morgan used a different methodology for determining the unemployment rate to the Australian Bureau of Statistics. If you look at the surveys that they were asking people and compare the ABS and Roy Morgan, I certainly I prefer the Roy Morgan methodology. Now look at the Roy Morgan one. They're saying our unemployment rate is at 8.7%. But what is more striking is the change from November to December. Here on Roy Morgan, they're saying we're going from 8.1% to 8.7%. Underemployment, they're saying went from 8% to 9.9%. Where the ABS is saying it's all good. Our seasonally adjusted figures have gone lower. Unemployment is down by 0.1%. What do you think the market's reaction will be to this data as opposed to the ABS data? Does this feel a bit better? Or I shouldn't say better. Does this feel more accurate? 8.7% unemployment, 9.9%, nearly 10% of people are underemployed. So you're talking 18.6% of people are either unemployed or underemployed. Nearly a fifth of the workforce. A fifth of the workforce, guys. So if we were reading headlines today saying 1/5 of the workforce underemployed or unemployed, that feels right, doesn't it? Let me know your take on this in the comments below, guys. And what do you think this year is going to bring us all? Thank you for watching. Please like, share, and subscribe to the channel. If you're a fan and you want to help us a little bit extra, we have a Patreon where you can make a small monthly donation. We also have the ability for you to join the channel here on YouTube, where you can get access to badges and emojis. We have affiliate links with Independent Reserve for your crypto trading and Amazon and eBay for your consumer purchases. If you use any of those services, guys, this is a great way to support the channel without incurring any cost to you. We also have merch at the HeiseSays website. We make our very own pocket squares, and PayPal if you want to support us this way. Thank you to everyone who helps the channel by watching, sharing the videos, subscribing, liking. I appreciate it all very much. And let me know what you think about this, guys. It's going to be an interesting year. I think it really is going to be an interesting year. One of the biggest challenges is everything just flows straight into housing. How are we going to get incentives to get investment in something other than housing? I'll leave that to you to discuss in the comments below. Take care.